But, on a balance of things, I think it's very possible to do it. If you can scrape $10,000 together and invest it not so riskily, you'll do that easily. I think it's 100x return. That's a lot.
The cryptocurrency market experienced its largest ever crash on October 11, 2025, when U.S. President Donald Trump's announcement of a 100% tariff on Chinese imports triggered a collapse of $19 billion in leveraged positions. Major cryptocurrencies such as Bitcoin, Ethereum, and Solana plummeted amid the drop. The overall altcoin market lost between 20% and 40% of its value, with over 1.6 million traders liquidated within 24 hours. This phase, lasting several days, prevents any immediate rebound. Once data flows and liquidity systems stabilize, large traders absorb sell orders to restore equilibrium. Eventually, traders liquidated their long positions acquired during the crisis, a process slowed by the weakened liquidity shortage. According to Raoul Pal, 100x is possible if you just buy and hold top coins like Ethereum, Solana, and others. Before we move forward, if you want to stay updated with the latest crypto events and news, you can subscribe to our channel and like this video. Now let's get back to Raoul Pal's view on Solana and the overall crypto market.
Nothing else exists like that. How I would do it is let's say you've got the 10 grand, put 5 grand in Bitcoin, and then figure out, can you take some speculative risk with the rest? I tell most people really to put 80 or 90% in the kind of top crypto. In 10 years, we're saying the whole market should be worth 100 trillion or more. I actually give that less than 10 years.
5 years?
8 years, 7 years, let's say. So in 7 years, the whole market's worth 100 trillion. So that's what, 25x from here? So then you just work that back and say, if I put 10 grand in, it's worth 250,000. So if I put 40 grand in, it's worth $1 million. Can you beat the 145% a year or the 100% a year or the 50% a year? No. So here we've got this digital property. There's only 21 million, so it's scarce. Why would you bother? You can make one investment and go to the beach and do nothing. Versus, I need to go and borrow money from the bank, hope the economic system keeps me afloat, hope I keep my job so I can pay the mortgage payments, hope the other one on the first property, I hope the other one, the payments the tenants can keep in their job, I hope. So you don't know. So the people who all bought office real estate, they're like, obviously companies, I just rented to them, they're brilliant, they always pay the bill. Well, everyone's working from home. You still run a lot of risk, but you don't get the returns you can from investing in crypto or even investing in technology stocks. And I like the idea of crypto and technology stocks, even as holding the two and then focusing the rest of the time, just keep focusing on your income, grow your income, build your business, do what you can, because you're investing past that 2030 date. You're investing in your own demise.
The altcoin market, already weakened by leveraged cross-liquidations on centralized exchanges, came under additional pressure. Arthur Hayes, co-founder of BitMEX, attributed the sharp decline in altcoins to automated collateral liquidations on CEXs, which intensified the price decline. Despite the turbulence, experts urged investors to buy the dips. Raoul Pal argued that long-term fundamentals remain intact, emphasizing the inevitability of a digital future and the need to focus on debt refinancing dynamics. Meanwhile, institutional demand remained strong, with ETF inflows totaling $40 billion in a single week. The crisis coincided with escalating trade tensions between the U.S. and China, which Trump's policies have increasingly exacerbated. The tariff announcements exacerbated macroeconomic uncertainty, with oil prices below $60 and falling treasury yields exacerbating market volatility. Looking ahead, the market's recovery depends on several factors. The altcoin seasonal index at 67 suggests that altcoins could outperform Bitcoin once liquidity returns to the sector. Furthermore, the cryptocurrency market's relative strength index, RSI, reached 35.3, indicating oversold conditions historically linked to rallies. Despite the shocking liquidation figures, Raoul Pal described the market reaction as background noise. According to him, the reaction came primarily from short-term traders who may have used leveraged positions. This could have a significant impact on their funds and represent losses given the decline in most assets. The cryptocurrency market fell 9.18% during this period due to its upward trend before the tariff announcement. Many investors were confident that the October rally would continue and had borrowed funds to bolster their positions. However, Raoul Pal maintained that for long-term investors trading with their own capital, market volatility is irrelevant. In the long run, it will not affect their investment results. For Paul, tomorrow will always be more digital than today, and therefore digital assets like Bitcoin, Ethereum, and XRP will always remain relevant. He believes the world will continue to digitize and that artificial intelligence, AI, and blockchain technology are essential for financial transactions. Paul emphasizes that if central banks and governments continue to increase liquidity, the cryptocurrency market will be supported, as an injection of approximately $10 trillion is expected over the next 12 months. The market analyst urged investors to take a long-term view and ignore the current liquidation noise. He advised industry players to buy on dips and accumulate more during this price decline. Paul emphasized that these fluctuations will no longer matter in the next 5 years. Market participants remain optimistic that volatility will give way to stability and recovery in the short term. Paul claims that cryptocurrency adoption could reach 4 billion users by 2030, which would bring the market capitalization to $100 trillion. This prediction would require the cryptocurrency market capitalization to grow from the current $4 trillion to $100 trillion by 2032 to 2034, driven by two factors that he identifies: adoption and currency devaluation. Paul's analysis is based on current cryptocurrency adoption metrics, which show 820 million active wallets worldwide in 2025 and over 520 million software wallet downloads worldwide. Institutional adoption has accelerated with the introduction of Bitcoin spot ETFs, which have attracted over $54.75 billion in net inflows since their approval in January 2024. However, reaching 4 billion users would require the cryptocurrency to serve half of the global population, a significant jump from current estimates of 500 million to 659 million users. According to Paul, as long as the world continues to digitize and liquidity continues to flow through the markets, the long-term outlook for Bitcoin and other cryptocurrencies will remain intact. Temporary market declines are simply the entry price for those participating in what he sees as a historic financial revolution. His advice was blunt, and with his typical boldness, he stated, "Stop predicting the market, think long-term, and don't fool yourself." Market data seems to confirm this cautious optimism. Bitcoin has recovered to around $112,000 after falling close to $102,000 earlier this week, with futures trading volume increasing by more than 150%, a sign that institutional players remain committed. For Paul, these moves indicate that savvy investors are quietly preparing for the next big cryptocurrency bull run. As liquidity increases and technology continues to transform finance, he remains confident that digital assets will lead global markets into the next era of growth.